We constantly hear about the explosive AI boom, right? The cloud, machine learning, but honestly, we rarely talk about the actual physical engines that fuel the whole thing. Welcome to The Explainer. Today, we're diving deep into the massive intersection of traditional physical utilities and this absolute digital explosion. And we're going to use Alliant Energy's Q2 2026 earnings report as our lens to do it. So let's jump right in.
It really is the multi-billion-dollar question, isn't it? How do you actually power the AI and tech revolution? We often think the magic happens entirely in software labs out in Silicon Valley. But the reality, it's heavily grounded in the physical world. The true backbone of this revolution is the massive, tangible infrastructure being built right now by regulated utility companies. Think of it like this. If the tech giants are building the brain of the future, utilities like Alliant Energy are building the cardiovascular system to pump the necessary power right to it.
To really understand this, we need to zoom way out. Let's look at Section 1, Powering the Tech Boom.
Okay, here is a staggering number to anchor us. 60%. Alliant Energy is projecting a 60% increase in total projected demand by 2031 compared to 2025 levels. Now, this isn't just your typical slow and steady population growth. No way. This massive surge is being driven by a whopping 3.4 gigawatts of total contracted demand from new customers alone. To put that into perspective, that's enough juice to power millions of homes, driven entirely by new tech customers. It is a monumental shift for a regional utility company. And well, it requires an equally monumental response.
So who's actually driving this incredible surge? Just look at the names planting their flags right in the Midwest. We're talking about tech giants like Google and Meta alongside major data center operators like QTS. What you really should take away from this is that these aren't just speculative plans sketched out on a whiteboard. Construction is already underway in places like Cedar Rapids and Beaver Dam. In fact, Google has already energized their transmission and is ramping up their loads as we speak. These tech behemoths are firmly anchoring their massive power needs right there in the Midwest.
So how do you actually prepare for that kind of mind-boggling demand? Well, that brings us to Section 2, building $13.4 billion of infrastructure.
When we hear the phrase data center, I think it's easy to picture a chilly little room with a few blinking servers, right? But the reality is actually these sprawling industrial-sized campuses. Powering facilities of this sheer magnitude requires an unprecedented level of physical infrastructure. It demands an unbelievable level of capital investment from the utility side just to generate and transmit that power reliably. It's a massive physical undertaking. And that brings us to the price tag, $13.4 billion. That's with a B. That is Alliant Energy's massive 4-year capital expenditure plan running from 2026 through 2029. It's a highly diverse investment plan designed to build out the necessary infrastructure to meet that tech-driven demand we just talked about. They are literally rewiring and upscaling their grid to support the future of computing. Let's break down how that $13.4 billion is actually getting deployed. To meet that 3.4 gigawatts of new demand, Alliant is utilizing incredibly flexible resource planning across Iowa and Wisconsin. They aren't just relying on one single power source. They've already secured turbines for all the necessary natural gas and wind generation. On top of that, they very smartly safe-harbored, meaning they locked in tax credits for all their renewable and energy storage plans to keep costs as efficient as possible. This diversified rapid response is fueling a really impressive 12% compound annual growth rate in their investments.
All right, let's see how this massive physical growth actually translates to their current balance sheet. Section 3, Q2 2026 Financial Scorecard. Now, if you just glance at the headline earnings per share, you might actually be a little confused. Despite all this massive growth in the data center expansion narrative, Q2 2026 EPS actually dipped slightly to 65 cents, down from 68 cents in the same quarter last year. But when you're building out for the future, the financials in the present can sometimes look a bit counterintuitive. Let's break down exactly why this happened.
It's a classic give-and-take scenario. On the plus side, all those big capital investments we discussed generated 18 cents of higher revenue, and they saw a nice 8-cent bump from corporate ventures. But, as we know, building the future isn't cheap. They faced 11 cents in higher operation and maintenance expenses, which is mostly labor and plant maintenance to get these new energy resources online. Add in 7 cents of financing costs to borrow for that $13 billion plan, plus a 5-cent hit from unexpectedly mild weather. Well, it's a textbook case of short-term growing pains to secure long-term capacity.
However, it is really important to anchor ourselves here, but remembering the broader picture. Despite that slight EPS dip from the operational and financing costs we just went over, the underlying business remains incredibly robust. GAAP net income for Q2 2026 was a highly stable, rock-solid $170 million. So the foundation is extremely firm and it's generating the cash needed to push forward with their ambitious plans. With Q2 officially in the books, what's on the horizon? Let's turn to Section 4, the outlook for 2026.
Leadership is clearly highly confident right now. As President and CEO Lisa Barton put it, quote, "We are positioning to accelerate earnings growth and enable significant economic development in the communities we serve, all while maintaining customer protections and reliability." They firmly believe that the heavy lifting and construction progress happening right now is going to directly translate into accelerated tangible earnings growth very soon.
And honestly, the numbers back up that confidence. They reaffirmed their 2026 ongoing earnings guidance of $3.36 to $3.46 per share. And notably, they mentioned they are currently trending in the upper half of that range. But if we zoom out even further, their aggressive long-term target is a 5 to 7% plus earnings growth rate. They expect to be hitting at or above the high end of that target between 2027 and 2029, which is exactly when these massive data centers hit their full load ramps.
So if you're tracking this space, here's exactly what you should be actively monitoring next. First off, they've explicitly teased the announcement of even more economic development projects, which, means more data centers. We're also waiting on a crucial FERC policy decision regarding how interconnection upgrades are funded. Plus, keep an eye out for more filings for renewable resources and, critically, a major update to their Iowa Resource and Capital Expenditure Plan expected in Q3. That one will include a newly signed 370-megawatt agreement. The momentum here is simply not slowing down.
Which leaves us with this final, truly provocative question to ponder. Are traditional utilities becoming the new tech growth stocks? I mean, for decades, utility companies were the ultimate slow and steady dividend plays. But as we've seen today with Alliant Energy, the explosive demand for AI and cloud computing is fundamentally transforming them into dynamic growth engines that are absolutely vital to our digital future. It completely reframes how we look at physical infrastructure. Every single time you ask an AI a question, remember, it relies on this massive grid. Thanks so much for joining me on this explainer, and definitely keep your eyes on the grid.